We'll kind of get started here. First of all, welcome to our Marshall Reddick December 13th webinar on 1031 exchanges, how to sell without paying taxes or to defer your taxes. I feel like that's a little safer option. My name is Ashley Robertson. I am a realtor here with Marshall Reddick as well as an advisor. You guys will get the great pleasure of learning from Dino Champagne this evening. Let me give you guys a little bit about myself here. My system is not wanting to let me go. There we go. Sorry about that, guys. A little technical difficulty. Here we go. A little bit about Marshall Reddick. For those folks who are new here, I did see a lot of our registrants are currently assigned to some of our in-house advisors, so I'm sure y'all are pretty familiar. Marshall Reddick, we have a 4-part business plan here. We are an active real estate brokerage representing buyers and sellers, both in primary purchase and sales, as well as investments. We operate as a private money lender, so folks who are looking for quick money or maybe can't qualify in a conventional sort of sense, we do private in-house money lending here, literally like 3 desks away from where I'm sitting now. We also offer full service property management. Property management is somewhere that I feel like we truly excel as kind of a bridge service between that brokerage and that lender, because we get to connect all the pieces there through the maintenance of relationship through property management. We also have an incredible, I think it's up to like $42 million in our investment fund right now. Separate way for people to invest with us. You can take that money and either lend directly through private money lending, or you can invest in our general fund, and that gets diversified out there as well. Really cool webinars on our Marshall Reddick website if you're interested in that. I know Patrick Prenti and Vince Tomich just did an in-person event that was really incredible. I believe there was a recording of it, but if not, there are others on the website that y'all could find. Highly recommend looking into that for those services you're not familiar with. A little bit about me. That's me. My name is Ashley Robertson. I've done a bit over 21 million in volume in my career. I am a 3rd generation realtor. I'm a single mama of 2 wild and sweet boys. They are 4 and 7. I got into real estate. I mean, it's in my family, but I came into real estate out of the food and beverage industry, but really with a passion to help people find their home and to help people find financial freedom within real estate as well. So I moved a lot in Mammoth as a kid, and so I really love seeing people find a space that they can settle into. And then once they find that, I love helping them find financial freedom. Obviously, as a single mama, that's super important and near and dear to my heart. I am a licensed California realtor, but I do work as an advisor in our other markets as well. My contact info is there, so feel free to save that if you guys need for later. One of our bits that I love about Marshall Reddick and kind of bringing those 4 sets of our business, the lending, the property management, the brokerage together, and how we're able to help and advise so many people find financial freedom, lands here in this investment methodology. It reads clockwise. We start with why. That comes in with the people who are here who have advisors, wherever you might land on this sort of timeline. Your advisors are there to help. Those who do not have advisors, I would be more than happy to set up a consultation after this to work through here and kind of see what you're looking for. What are your financial goals? And then we just tick through these. How do we do that? What do we need to do in your personal finances to create freedom and set you in that timeline for buying? What are your baseline criteria? What's the most important thing on your return on investment? What markets are going to fully support that? And then how do we get you connected to the key players within those markets to make you as successful as possible and help you find that financial independence? A few of the markets that we are in. So you will see a variety of markets here. The ones that are highlighted or boxed in green here are places where we physically have team members. We are boots on the ground, team members going. For those of you who don't know, Marshall Reddick is a gentleman from, gosh, Marshall just celebrated his 80th birthday this year. He started our company as an educational sort of facility and then did referrals nationwide. Our new owners, Scott Pastel and Ross Nelson, saw the opportunity to get agents and boots on the ground here in these different markets. These markets are very specifically chosen. On the next screen, you'll see why. But that is where we physically have our Marshall Reddick team members within property management, brokerage, private lending, and the mortgage fund. The other ones that are not boxed in green are different markets where we have affiliate third-party people that we work with extensively. We do offer referrals basically nationwide, but these particular markets, Phoenix, Boise, Indianapolis, Memphis, and Dallas, are places where we don't have our own Marshall Reddick team members, but we work very extensively already. A few of the places why we have chosen to put boots on the ground where we have very, very basic care. You need to have jobs in order for people to be able to make money, to have consistent investment income, lower vacancy rates, economic diversity. You don't want all of your eggs to be in one basket, so to speak. You don't want a demographic or an economy that is based solely on one industry. So we want that to be diversified there. Housing affordability, obviously. More affordable housing can yield a higher, more substantial long-term holding sort of return. Landlord friendly. We like to be in states that are very, very landlord friendly so that we can represent our investors and our landlords as beneficially as possible. Strong education. We like a lot of places with higher education, universities, military, places like that, and places where we feel we can set reliable property management. So that is a little bit about what Marshall Reddick does, who I am, what we have to offer. A big part of what we do is 1031 exchanges. We have the honor tonight of bringing in Dino Champagne. She is an absolute powerhouse in the 1031 world, and I'm super excited for you guys to get to learn what a 1031 exchange is, how it can be beneficial in your real estate processes, and how it can help create financial freedom for you. We are not going to have questions within the webinar this evening, but I will personally be following up with everybody who attends, and you'll have the opportunity to put questions in an end of webinar survey. So please hold your questions there, and welcome Dino Champagne. I am very, very excited for you all to get to learn from her tonight. I think you guys are in for a real treat.
Well, thank you, Ashley. No pressure there. Welcome to the webinar. Let me just give you a little bit about my background and then the company that I work for, Asset Preservation's background as a 1031 company. Asset Preservation is a national 1031 firm and has facilitated, we have facilitated over 200,000 exchanges since 1990. So that's how long we've been doing this. We're owned by a large title company. So, you know, you have the financial backing of the title company that's been around for over 115, 120 years. Our parent company happens to be Stewart Title. We do work with all title and all escrow companies, so we're not exclusive to one. But the reason I bring it up is because our industry is not regulated. So you just want to make sure that you're working with somebody that's been in the business a long time and has the financial security, because we do have your funds when you're doing a 1031. My background, I joined Asset Preservation as a division manager. I'm a vice president now, but a vice president division manager since 2002. So I've been doing this for 20 years. Prior to joining Asset Preservation, I spent about 14 years as a commercial broker and 14 years as a banker. And this is why I'm glad that there's no visual. but because you'd see my age. Anyway, so that just kind of gives you an idea of who we are, who I am, how long I've been in the industry. So what I'm going to do tonight is we're going to just take you through, the taxation when you're talking about selling an investment property. I'm going to take you through Section 1031 because it's actually a part of the tax code. We're going to go through what is like-kind property, what you have to meet to facilitate the exchange. We call it the exchange equation. I'm going to take you through the process of the exchange and the identification rules, and then some tips on how to complete a successful exchange. I'm not going to be able to cover every aspect of 1031s in a seminar that's only about an hour, but I'm going to give you basically the meat and potatoes, and there's always going to be some nuances to everybody's transaction. So this is just giving you the skeletal aspects of it. And I do encourage you, if you have questions, like Ashley was saying, make a note of what questions you might have, and we'll definitely, she will send the 1031 questions to me, and I'll be more than happy to answer those questions. Okay. All right. So let's take you through 1031. Why do people do 1031s? Well, when you're selling investment real estate, there's going to be potential taxes. So there are 4 different tax categories when we're talking about selling investment real property. There's depreciation recapture, there's the capital gain rate, there's the net investment income, and if you're in the state of California or any state that actually has an income tax, you're going to be faced with the state income tax as well. So when we talk about depreciation, that has a special tax rate to it. If you're not familiar with the term depreciation, if you're a new investor and you're just getting into this, one of the beauties of owning investment real property is that you get to depreciate the property. And depreciation basically means that you're lowering your real estate taxable income, while you're operating the property. And it's a non-cash expense. So there's going to be expenses to owning real property, and then there's going to be expenses that are non-cash, and depreciation is one of them. But there is going to be a tax at the end because you are, lowering your real estate taxable income. And that tax rate is at 25%. Then there's the capital gain tax rate. Now that tax rate can be either 15% or 20% depending on what your income is. That adjusts every year to the cost of living. So based on what your how much income you have with the transaction as well as what you're making, that's going to tell you what category you could potentially be in. Are you going to be taxed at 15% or are you going to be taxed at 20%? And then there's the net investment income tax. And people know it as the Obamacare tax. That's an additional tax on selling investment property of 3.8% if your income is more than $200,000 if you're single and $250,000 if you're a married couple. And then there's the state. State of California ranges anywhere from 9.3 to 13.3. So those are the 4 taxes that an investor would be faced with when they sell investment real estate. So let me kind of just drive the point home. Say, for example, somebody sold a property and their gain on the sale of the property was around $700,000. In that particular transaction, if they were a California resident, that they're looking at potentially having to pay $255,000 in taxes on gain of, say, roughly $700,000. So when you think about you selling investment real estate, if you have to spend $250,000, that means you're buying less property. So that's the beauty of a 1031, because you get to defer that tax, and now you can use all the cash coming out of your transaction to go buy more property. Now, in order to do that, there's always some pros and cons to the 1031, all right? So the biggest advantage to the 1031 is obviously you're deferring the tax. You're deferring the recapture tax, the capital gain rates, and the state of California's income tax. Most of the states do comply with 1031s. Next year, Pennsylvania will actually be joining and complying with 1031s. There's certain states that have some nuances to it, so you want to make sure that whatever state you may be selling out of, you want to check to whatever that state law is, how it complies with 1031s. And you're also deferring the net investment income tax. So that's one of the big advantages of 1031. Another advantage is, like I mentioned a little bit earlier, you get to, you're building your wealth, you're preserving equity. And what I mean by that is I gave you the example, if your gain was like $700,000 and you had to pay $255,000 in taxes, well, by doing a 1031, you're preserving that equity, which gives you the opportunity to go buy more property. Doing a 1031 leverage can also be a very good advantage. If you own a property, for example, that does not have a large loan on it, and you sell it, you can go out and buy more property by utilizing leverage. And that when you sit down with, like with Ashley and go over your goals and plans, I mean, that might be something you want to discuss. Do I want to get, use leverage so I can buy a lot more? And that's going to be a personal decision for most. Then there's the diversification. In the 1031, you get to diversify geographically. We have seen in our industry that a lot of people have been moving, they may have some rental properties that are in California, and they're moving them to other states that are more landlord friendly, that are more cash flow friendly, if you will. So you can move geographically. See, a 1031 is a federal tax code. So you can exchange anywhere within the United States. Okay, you can diversify by asset class. So, somebody might have an apartment building and maybe they want a single tenant triple net, or somebody has raw land that they've held for investment, and we know raw land typically is not going to be producing any income. They sell that raw land that they held for investment, and they go off and they buy some income producing properties such as single family rentals, maybe an apartment building and such. And then another advantage, while we still have this part of the tax code, is estate planning, in the sense of, right now, if somebody passes away, there is what's known as a step up in basis. So there would be an appraisal done, and then the market value would be stepped up to the heirs that have the property. So when people are doing exchanges, they may exchange, and when they pass away, their heirs will inherit the property. And the capital gain tax and all the taxes associated with all of the exchanges that they've done is not passed off to the heirs. All right. So it's very, it's a strategy that can be used for estate planning. Now, it works as long as we still have the step up in basis. Sometimes Congress talks about getting rid of that. Right now, we still have it. All right. Now, with every pro, there's going to be cons. So there's going to be certain rules and guidelines and time restrictions in order for you to complete the exchange and defer the tax on the sale of that property. Another downside to the 1031 is the replacement property basis. Without getting too deep into the weeds, what that means is that you have a basis when you acquire a property, and then that basis is adjusted throughout the ownership of the property. That basis is what determines what your gain is after your sale price. When you're doing an exchange, that basis moves over with you. So in other words, if I have a property that I sold for, say, $500,000 and my basis was $200, that means my gain is $300,000. If I buy a new property for $500,000, I don't get a new basis. My basis is not 500. It's 500 minus gain deferred, which was the 300,000, which means my basis is 200. So my basis moved with me. So that is a downside to the 1031. Lack of liquidity. You have to buy real property. So sometimes people go, well, can I keep some cash? Well, any cash you keep, you'll pay tax on. All right. You cannot recognize any losses. So it's so important that when you're doing a 1031, that you're actually consulting your tax advisor to make sure that in your transaction, you're going to benefit from a 1031. We as a 1031 company are not going to know that. That's why you need to speak with your tax advisor, to determine, do I need to do one based on my circumstances? Is there a possible risk of higher taxes in the future? Yes, that's always a possibility. And again, remember, it's only tax deferred. It's not tax free. You'll never hear me say tax free on a 1031. You're deferring the tax, and at any point in time, you can decide to pay it, okay? Or you can continue to exchange until you pass along. Okay, now let's go about the basics of the 1031. So those rules and guidelines I was talking about. There are going to be 4 basic guidelines to complete a 1031. One is the property has to qualify. So was the property held for trade or business or for investment? Okay, that's the first one. The second criteria is going to be how much you have to spend. When you're doing a 1031, it's not just the cash coming out of the sale, nor is it just the gain that gets deferred. When you think about a 1031, think of it as a continuation of ownership in real property, although it's going to be in a different property in a different location. So you have to spend all the cash coming out of the sale. You have to replace any loan if you had that was paid off, and you have to purchase property equal to or greater than the sale price minus the closing cost. Now, don't worry, we're going to drill down on all of this. The next requirement is the timeline. Regrettably, you don't have forever to do this. So you have very specific and statutory timeframes when it comes to a 1031. You're going to have 45 calendar days from the date of the sale closing to identify the replacement property or properties. You have an additional, I like to say 135 days to finish the exchange, okay, which gives you 180 calendar days to complete your exchange. Now, I'm going to go on. There's a little nuance right now. If you're selling this time of year, now we're getting to the end of the year, but if you're closing on a transaction between, say, October 17th and December 31st, you're going to have to be careful not to file your tax returns too soon, because the tax code reads that you have a 180 calendar days from the date of closing or your tax filing date, whichever is earlier. So people that are closing during this time of year, in order to get the full 180 calendar days, they need to file an extension on their tax return. Okay, so these are some of the nuances. And then the fourth requirement is the identification rule. So you have to properly identify the properties or the property or properties that you wish to purchase as a part of the exchange. So now let's go through all of these items one by one. Okay, so let's talk about the property, the qualifying. You've probably heard the term like-kind property in a 1031. The term like-kind property does not mean duplex for duplex or apartment building for apartment building or shopping center for shopping center. It's pretty basic. It means property that was held for trade or business or for investment. Okay, so we're talking to investors today, so we're talking about investment property. And you have to buy property, real property, that is going to be held for trade or business or for investment. So if I have, again, if I have a raw land, I can go off and I can buy a duplex, or I can buy, I can buy an industrial building or a single tenant triple net or a commercial shopping center. So like-kind property, if you just keep that in mind, it's investment real property for investment real property, okay? So that's what like-kind means in the 1031. It does not mean single family for single family, duplex for duplex, apartment for apartment. All right, so that's the beauty. You have some broadness there in the product type you can get, all right, but it has to be investment real property. Now, let's talk about what's excluded. If you're selling a property that you're living in, it's your principal residence, and that's all it is, then that does not qualify for a 1031. That's a completely different tax code. That's IRC section 121. What's also excluded is property that's held for sale. So in other words, if you go out and you decided that you wanted to start buying properties where you want to fix them up and flip them, that doesn't qualify for a 1031, because your intent is not to hold the property for investment purposes. It's to fix and sell or build and sell. It's considered dealer property, and it's not looked at as 1031 quality property. You can't do that in a 1031. So people say, well, how long am I supposed to hold? We'll get to that in a second, all right? So just think of it as your principal residence. If you're living in it at the time of sale, that does not qualify for a 1031. And if you have property that you've used to fix and flip, that does not qualify for a 1031. It has to be property you intend to hold for trade or business or for investment. Now, A lot of times people say, well, you say I have to have the intent to hold. Well, how long do I have to hold the property for? Well, there's nothing in the tax code that mandates a specific holding period. So this is where you're going to look to your tax advisor to get the answer to that question. You know, now some tax advisors that are more conservative say, well, I want my client, you know, holding the property for at least 24 months or 2 years. All right, the code doesn't mandate a 2-year holding period for unless you're dealing with a related party, which I'm not going to get into today. But in general, if you're selling, you know, you're selling to somebody else, there's nothing that mandates that you have to hold it for a specific period. So you want to talk to your tax advisor. Can you substantiate your intent by the time? Another one might be a year. Some tax advisors might be a little bit more aggressive. They say, well, if you hold it for a minimum of 12 months and a day, then we feel, you know, then I feel that you can make the argument that you intended to hold that property for investment purposes. So the reality is that the party that's going to be answering that question about did you have the intent to hold is going to come from your tax advisor. That person has to be the one to tell you, yes, I think you're okay to do an exchange with your holding period, or no, I don't think you should be doing one. Okay, so there's nothing mandating a specific holding period, but you definitely want to consult your tax advisor to determine that your situation qualifies as that you held the property for investment purposes. Okay, now let's go to the next requirement, which is what we call the exchange equation. So how much money do you have to spend in order to defer the tax? So here's an example. If property was sold for $900,000, at the closing they owed $300,000. There's going to be closing costs, real estate commissions, title, escrow, transfer tax, and such. Let's say that transaction was $60,000. So that means the cash that came out was $540,000. This investor went out and they bought property at $1.2 million. They put the full cash down, the full $540,000, and they utilized leverage to buy roughly $300,000 more in property than what they sold for. So this is an example where you spent all the cash, you bought higher than what you sold for, you replaced the debt, and you would have deferred the gain on the tax on the gain of the sale of this property. That's the target for most 1031s. Now, there are times where people may not either buy enough property or choose not to buy enough property. Okay, they either, for whatever reason, they're deciding to go down in value from their sale. One of the things to understand is that you can do a partial exchange when it comes to a 1031. You just want to make sure that it's going to make sense if you're going to do that. Now, when you're doing a partial exchange, the portion that's not reinvested, in other words, if you don't spend all the cash or you don't replace the debt, that means that you have either mortgage boot, which means that you did not replace all the debt, or you have cash boot, which means you did not spend all of the money. So in my example here, we've got sale of $900,000, $300,000 loan, same $60,000 closing costs, $540,000 of cash coming in. The investor goes out and buys something for $700,000, but they only wanted to get a loan of $260,000. So they did not replace the loan, which was $300,000. So they have $40,000, which is known as mortgage boot. And then the investor only put down $440,000. So they didn't spend all of the cash. So in this example, they are going to pay tax to the amount of gain on $140,000. Now, what you have to find out is, did I still benefit from the exchange? So just very quickly, if the taxpayer's gain on the sale of the property was, say, $300,000, and the boot, the portion they did not reinvest, was $140,000, they still benefited by buying down in value. They still deferred tax on $160,000. Now, where this would not make sense to do in a 1031 world would be if the gain on the sale of that $900,000 property was only $100,000. Then they would not have benefited from the exchange because they're going to pay the tax on the $100,000 like nothing happened. So you can do a partial exchange, but when you're considering one, you want to make sure you're still going to benefit from the exchange. Now, the next slide I want to just show you is because you have to be very careful when you're doing the 1031 that you're not solely focused on the purchase price saying, okay, I'm buying higher than what I sold for, so I'm good to go. So here's an example where that would not be the case. sold for the 900, buying for $1.1 million, got a loan of $700,000, but only put $400,000 down. Did they spend all the cash? No. So even though this transaction bought higher than what they sold for, because they did not spend all of the cash, that $140,000 is taxable. So when you're doing a 1031, and say Ashley's out there helping you to find the replacement properties, knowing how much down you have to put down is going to be really important, because you want to make sure that you're spending all of the cash, all right, in the 1031. So this is what's known as the exchange equation. Now, there are certain closing costs in a transaction that are considered acceptable exchange expenses, and there's some that are not. So just here, I'm just going to give you a brief overview of what this looks like. Acceptable exchange expenses: real estate commissions, title insurance, closing fees, escrow fees, any legal fees associated with the transaction, transfer fees, notary fees, recording fees, the qualified intermediaries fees. Those are all costs of transferring the property. Those are considered acceptable exchange expenses. But there are items that are not, they do not qualify, that may be a part of your transaction, which could end up with some tax liability. Prorated rents and security deposits. If you're selling a building, for example, that you're going to be the tenants moving over, say for an apartment building, you see this a lot, okay, where there's prorated rent. So there's going to be how much rent that has been paid for that month now has to get transferred over to the new buyer of the property. So there's a lot of times where the negotiations will credit the buyer with the prorated rents and security deposits. So in other words, if the prorated rents and security deposits that have to get transferred over to the new buyer are, say, $50,000, and the seller says, okay, I'm just going to credit you with that, that means the buyer is not bringing in $50,000, and that $50,000 is going to have a taxable impact to the seller doing the exchange. When you're talking about financing, there's points. Points are a cost of buying money, not an exchange expense. Prepayment penalties, that's financing issues. Paying the buyer's closing costs, we see a lot of that, okay? That can be subject to tax. You want to talk to your tax advisor to determine how that tax advisor is going to allocate those, that cost of paying the buyer's closing costs. Lender policy, any kind of impound such as property taxes and insurance, all right? Those are not considered acceptable exchange expenses. So when you find yourself in a 1031 transaction, you definitely want to make sure that you're talking to your tax advisor and the qualified intermediary to go over some of these issues, all right? Now, let's take you now through the actual process of the 1031. You have your property, you've consulted your tax advisor, you decide I'm going to sell it, I have capital gain tax, I want to defer that. So my role as the qualified intermediary is going to officially begin once you get in contract with a buyer and you open up escrow, all right? Because we have to have a contract that we're assigned into. So we're going to be communicating, we as the qualified intermediary, we're going to be communicating with the settlement agent, so the escrow officer or the attorney, depending on what state you're selling out of. We're going to request a copy of the contract. We're going to request a copy of the title. Then we're going to prepare exchange documents. Those exchange documents must be signed prior to the closing of the sale. Must be signed prior to the closing of the sale. So your exchange has to get set up before the escrow closes. When the escrow closes and the buyer brings in their funds, the deed of the property is going to get transferred over to the buyer. The money is going to be transferred to the qualified intermediary. The date of the closing is now going to start that infamous timeline in the 1031. So this is where the 45 and 180 calendar days begins. Notice I said calendar days. It's not business days, it's calendar days. So you have to identify what you're going to buy by the 45th day, and you have to complete the transaction by the 180th day or your tax filing day, whichever is earlier. Now I'm going to come back to the identification in a minute, but I'm just going to take you through the cycle of the exchange. So now you get in contract with the replacement property. The exchange documents for the purchase has to be prepared and you must sign it prior to the closing of the sale. When you're ready to close, then we're going to now wire the funds into the escrow or the closing, and then the deed to the property is going to be transferred to you. So that's the cycle of the exchange. And I always kind of chuckle. Simple, right? Because we're we're doing this on a webinar. So yes, everything is moving very smoothly on the webinar. All right, but we're going to drill down just a little bit deeper, because the challenges when we talk about 1031 is going to be the identification. All right, because you have to identify what you're going to buy within that 45 days. Now, there are 3 rules. You get to select one of the 3 rules that you're going to use for the 1031. The first rule is known as the 3 property rule. So if somebody's doing an exchange, they can identify 3 addresses. No limitation to the dollar amount to any of those addresses. So if I sold for the 900,000 and I'm saying buying just one property, well, I can identify 3 properties. Maybe I identify one for $1 million. Maybe I identify another one for $1.5 million, and I identify a third for $1.8 million. Okay, and I can buy whichever one of those 3 I want. If I want to identify 4 or more properties, now I'm moving out of the 3 property rule, and now I'm going into the 200% rule. The 200% rule allows me to identify 4 or more properties, so 4 or more addresses, but the fair market value of all of those properties that I've identified cannot exceed 200% of my sale price, or 2 times my sale price. So if I sold for 900,000 and I'm using the 200% rule, the maximum value of all of those properties, say 4 or 5 properties, cannot exceed 1.8 million. See, they have restrictions when you're identifying 4 or more properties under the 200% rule. So generally speaking, when people are asking about which rule they can use, I'm going to ask the question, if you're talking to me, I'm going to say, how much are you selling for? And where are you planning on buying? And what's the average price in that area? And then that will tell me which rule is going to be most appropriate for your 1031. Because if you identify more than 3 properties, so 4 or more, and the aggregate values of all those properties exceed 2 times your sale price, now you're into the 3rd and final rule, which is known as the 95% rule. Under the 95% rule, unlimited properties, unlimited dollar amount. But here's the catch. You have to close on 95% of all the values, all the properties you've identified. So basically, you have to buy your entire list. That is not a rule you ever want to go toward unless you feel very, very confident that you're going to be able to close on everything you've identified. Okay, now let's go over what identifying is. It has to be in writing, has to be unambiguously described, has to be sent, and by midnight of the 45th day. All right, delivered typically to the qualified intermediary. Identifying is a formal process to the 1031, okay? This is what our identification form looks like. What you have to understand when you're doing a 1031, that while you might be in contract with a purchase, that contract itself is not the formal identification form. So if you're going to be in contract with the property, which my recommendation is you should be, okay, not mandatory, but you should be in contract, because you can only buy what you put on the list. If you're in contract with that property, you still, if you're not going to close until after the 45 days, you still have to fill out the ID form. And a lot of times people miss this step, and you've got to be very, very careful, because if you don't properly identify a property, then it's not considered like kind in a 1031. So just so you know, the identification form is a separate form from the contract itself. It has to be completed. You have to put the address, the city, the state. If you don't have to add up any values if you're staying within the 3 property rule and you're buying by yourself. If you're in the 200% rule or the 95% rule, you have to add up the values. You have to sign it, you have to date it, and you have to send it in. My recommendation is you always do it during business hours, so if there's any issues, it can get addressed. If you send it in beyond after business hours on the 45th day, the next day is day 46, and there's not a thing that can be done to correct any errors that were on the ID form. So the ID itself is a very, very critical document to completing a 1031. Okay, now I'm just going to take you through, sometimes people are looking to consolidate. So they might want to sell multiple properties to buy one property in exchange. And the reality is you can do that. Here's what you need to know if you're thinking about selling multiple properties. So maybe you have, a property in Indiana, you have a property in Alabama, you have a property, maybe in Arizona. And you say, I want to sell these 3 properties so I can buy maybe an apartment building in Florida. Okay, you can do that. What you have to understand is the time frame for the exchange when you're trying to do a multiple property transaction. The 45 and 180 calendar day period is going to begin at the closing of the first property. At the closing of the first property. You cannot close on your purchase until that 3rd property has closed. And you have to identify the property or properties you wish to purchase by that 45th day. So when you're considering something like this, you just want to make sure that you're going to be able to accomplish this, especially if you're in different markets in different states, because it's going to be really critical to try to get these lined up as close together as possible so you can feel confident that you can complete the transaction successfully. Now, what we see more of is this. Somebody's selling one property and they're doing the 1031 and they're buying multiple replacement properties. Okay, happens all the time. So in that instance, you want to just make sure that you're identifying all your properties and that you close on that last purchase within the timeframes of the exchange. There have been occasions where, investors have closed on 1 or 2 properties, and that 3rd property might have been, say, new construction, and there were some delays to new construction. That can end up being a problem for the 1031 if you cannot get it completed. All right, so again, it's about making sure that your transaction, that you're able to accomplish what you want to accomplish in these restrictive timeframes. Okay, remember I said there's the restrictions to the 1031s, and these timeframes can be very restrictive if things aren't lining up properly. Okay, now let me just take you to what I think are some tips to help you execute a successful 1031. Like I said, I've been doing this for 20 years. Okay, so these are my tips for you. One is I think it's so important that you consult your tax advisor or your CPA. Hopefully your advisor is somebody that understands real property and understands 1031. You want to make sure that when you're considering selling the property, do you need to do a 1031 based on your set of circumstances? So in other words, that party should be calculating your gain for you. How much gain do you have, and what are going to be the tax implications for selling? You as an investor may have some losses that can offset some of the gain. If you don't need to do a 1031, you don't want to do a 1031 because then you can just sell and then your losses may offset the gain. And then you could go off and you could buy replacement property and have, take your time and not be restricted to the time frames of a 1031. You want to make sure that your accountant, your tax advisor are reviewing the closing statements. So the closing statement from your sale and reviewing the closing statements from your purchase. I know it sounds silly, but there are a lot of times where the accountants are not reviewing these and there are issues that come up. So you want to make sure that your tax advisor is engaged in this transaction along with you. right? So just make sure that when you're doing something like this, that you're consulting your tax advisor early on. Now, the next thing is, obviously, you're going to discuss the 1031 process with a qualified intermediary or an accommodator. So someone like me, that's going to be a separate conversation than you're going to have with your tax advisor. I'm going to take you through the process pretty much like I've just done now. I'm going to go through the rules again, the guidelines. I'm going to talk a little bit about your transaction. I'm going to go over the steps of what you can expect, in this transaction. So in other words, I like to tell folks, okay, these are the time frames. This is how much you have to spend. I want to know, how you own the property. How have you been reporting it on your tax returns? I'm going to explain what's going to happen next. So, I'll say, for example, you have your real estate contract, you have your escrow documents, and then you're going to have the 1031 documents that you have to sign. So I'm going to bring you through the steps of what you can expect when you're starting to do a 1031. Now, it's going to be important as investors to become familiar with these requirements for full tax deferral, as well as the financing component. So in other words, how much do I have to borrow? So you want to know what's my cash coming out of the sale, what your loan payoff is going to be roughly, how much do I have to spend? I want to know how I have to properly identify the replacement property. You have ownership in this because you have to understand you're the one doing the transaction. So it's really important for you to get familiar with these timeframes, get familiar with the requirements. And to me, bringing in a lender early on is important, because if you haven't been in the lending arena for a while, it may be all new from the last time you did any kind of financing. So you want to make sure that your lender's on board and knows how much you have to spend. When you're buying multiple properties, it's up to you how you wish to use your money in the 1031. It doesn't have to be divided equally. You can put more down on one. Maybe you pay all cash for a property and finance the other. It's just a combination of everything. So again, get familiar with the requirements. I'm not saying you need to be somebody like me that sits and talks to stuff all day long, but it is your transaction. So you want to know, how much do I have to spend? Look at those numbers, look at those closing statements, and have conversations with the lender about financing. All right. And then also, if you have any difficulty or concerns about how do I properly identify, make sure that you're having a conversation with your accommodator to go through. Yes, you have to put the address, the city, and the state. I've had some people go, oh, I know it. They send the identification in at 11:30 at night. The next day is the 46th day, and lo and behold, they never put the state down. They put the address, they put the city, but they did not put the state. That is not properly identified. So you just want to make sure to understand how you properly ID. Okay. The next thing I think is important is confirming your tax ownership to how you're vested on the property. There's a lot of times where people may own a property for a long period of time, and throughout this entire ownership, they've changed how they are reporting the property on their tax returns. So, for example, maybe a husband and wife have owned the property in their individual names, and then they decided, for whatever, they talked to their tax person, and the tax person said, no, why don't we put you into a partnership? So they created the H&W Properties Partnership, okay, LLC, that's taxed as a partnership. But they never bothered to change the title on the property itself. You go to sell the property, the real estate agent seeing what's the vesting, the escrow officer seeing the vesting, which is not matching how you have been filing your tax return. So it's important to take a look at how you're showing title on the property and make sure that it's accurate to how you've been reporting it on your tax return. I will have to say that if I ever have big headaches, these are usually the ones that come into the 1031, because there are more times than not that the accuracy for the tax reporting does not match how it's showing on title. So if you can get this addressed when you're at the listing stage of your sale, that will help things go smoothly, because if something needs to get corrected, you can get it corrected before you have a buyer and you're opening up escrow. So very important because these things can go wrong very fast. And generally this stuff hits probably about a week or two or even less time before the sale's ready to close. All right. And then that creates an issue for the 1031. And then I would say one of the most important things is communication. It's important for, if you're doing a 1031, for you to be proactive in your transaction. So you're going to be working, with your real estate professional, finding that suitable replacement property or getting that relinquished property sold, understanding your time guidelines for the 1031, and then staying engaged in your transaction. You've got to stay involved. If you stay involved and you ask questions, then when that happens, then you're going to have more likely going to end up with a successful 1031. So those are just kind of my tips, if you will, to how to have a successful 1031. So here is my contact information. If you ever have any questions about 1031s, you've got my number, you have my email address here. Feel free to reach out to me. More than happy to answer your questions. So now I will turn it back over to Miss Ashley.
Thank you so much. You guys, I know that was a ton of information, and depending on your familiarity might have been like, whoa, a little overwhelming, but please do not hesitate to reach out to Dino. My information will be on one of these slides as well. Some fun sort of resources that we have here at Marshall Reddick. We've got our property rating book. You can find that at www.marshallreddick.com/ebook. That will help break down, it's about 30 pages, I believe, the last time I read it. It'll help break down choosing an appropriate sort of investment property, how we classify properties, and choosing what the most beneficial will be based on your personal needs. That's just a separate identification from a 1031, but very beneficial when you are in the process of a 1031 as well. All of our educational videos and articles here, marshallreddick.com/learn. That's where you can find those other videos that I spoke about. If you are interested in, different markets, in our mortgage fund, in our private lending department, all of that can be found there. That is my contact information right there. That is my personal cell phone number, 760-937-6091, or you can email me at ashley.robertson@marshallreddick.com. You can also fill out a consultation form there through the website. Like I said, I will be following up. Please feel free to put questions in the survey and send those through, and then I will be contacting everybody within the next day or two. Really appreciate all of your guys' time, and I hope that you have a beautiful evening and a very, very happy holiday season. So thank you, Dino. I appreciate your time as well, and look forward to getting to do another webinar with you soon.
My pleasure. Thanks for having me.
All righty, take care.